We'll get started with the last panel. In a way, this is a great panel to wrap up because the panel's dedicated to looking at national oil companies and looking at them in two very important contexts. The international capital markets and the relationship with the international oil companies. We're fortunate to have Thomas Langford from Morgan Stanley to talk about the capital markets, and then Amy Jaffe, who's worked a great deal on national oil companies and international oil companies interface. Amy will close it off talking about nationalization and investment cycles. Okay, Tom?
Terrific. Thank you. Okay. Well, first, thank you for the opportunity to say a few words today. Always tough to be the last panel before the break, but why don't we go ahead and launch into it. First of all, let me just say my presentation is from a capital markets perspective, and what that means is, as an investment banker, it's my job to represent my clients to the capital markets, and certainly it's also my job to give a lot of thought and to try to have a point of view on what the capital markets are looking for the companies that I do represent to the markets. Before I specifically launch into a discussion about some of the opportunities and challenges of Latin America national oil companies, I think I'd first just like to frame a broader discussion of NOCs and IOCs, and then I'll quickly then put Latin America national oil companies as well as Chinese and Russian national oil companies in that framework, if that makes sense. So with that, I think we're all aware of the structural changes going on in the industry, in the energy industry. And if you take the perspective of an international oil company, whether it's falling reserve replacement, increasing cost, flat or declining production volumes, they're really symptoms of all one specific cause, and that is that energy is really moving to the emerging markets, and that the national oil companies, as the owner of those resources, are increasingly advantaged. I think the capital markets is certainly, over the last 4 years, has come to that realization, and we've seen a tremendous move of value to the emerging markets. So much, in fact, that I would say really it was I think easy to observe that the IOCs, as winners of the last decade, were really not likely to be winners in this decade. And to a large extent, I think that was becoming the conventional wisdom up until the point of really the financial crisis and the collapse in commodity prices. And I think what the markets are telling us now is, hey, wait a minute, maybe we're a little too quick to that judgment. Let's not write off the IOCs just yet. So let me just quickly go through a series of slides to really try to put some market realities against this topic. And I think the punchline, at least as I would come away from this, is that we're going to have an interesting next couple of years. So first, let me put forward some observations around the logic of the IOCs and the IOCs really losing some of their logic of leadership. This chart, and I apologize for the scale, hopefully everybody can see this. This chart really shows since 2004 to the point of peak oil prices in July 3rd, 2008, the relative share price performance of the yellow line, which are the international oil companies, which have effectively appreciated about 91%, versus the national oil companies at well over 400%. During this same time period, a lot of things were happening in the markets also. The markets were clearly moving from the perspective of really gauging companies on absolute performance versus relative performance, global versus regional. And I think at the end of the day, what the markets were really starting to look for is absolute performance across a much broader array of companies. If you go back to earlier in the decade, really, as an investor, you did have some choices, but the investment landscape was really dominated by the 5 super majors. If you were a portfolio manager, winning or losing was really a determination of which 1 or 2 you picked as the likely outperformers. As we advanced into the decade with the various privatizations and the emergence of and expansion of some of the market capitalization of the existing participants, we ended up in a period where we had 14 or 15 companies greater than $50, $60 billion of market capitalization, both NOCs and IOCs. So therefore, if you were a large portfolio manager, you really had real choice as to where to put your capital. But I think the punchline from this chart is that the IOCs, through at least the last decade, weren't the superstars that they once were. If you look at this same performance since peak oil in July 3rd, 2008, and you chart that to the present day, what you see is a real reversal. And on the way down, the IOCs have clearly led, declining only around 35%, versus the national oil companies, which are down much more significantly in the range on average of around 65%. So it really does beg the question, is this just a commodity collapse phenomena or a financial market crisis phenomena, or in fact is there something more fundamental here, and what can we learn from it? If you think about the equity trading dislocation or the financial dislocation, I guess that's just kind of a nice way to say that regardless of where you put your money in the market, you lost money. If you look at on what is the left-hand side of this chart, the various sectors of the S&P 500, and this just looks at the share price performance of those sectors since the first of this year, essentially everything has lost money. Not surprisingly, financials have been hardest hit, down well over 40%, but energy really hadn't done that badly, down around 12%. I'd say more importantly on the right-hand side chart is how Wall Street is thinking about future earnings and how they're thinking about earnings through the course of 2009. The little yellow bar is actually the historical 2007, last year basically. The green bar is this year forecast. And as you can see, most all the sectors are down with the exception of financials are expected to increase earnings sharply this year. Of course, anything off of the zero is a big increase. Consumer discretionary also expected to increase. But you'll see the other sectors are all generally negative. With energy down, projected to decrease in earnings around 50%. And given that a lot of that decline is really driven by an expectation on Wall Street of a continuing decline in commodity prices, then I think it's fair to say that the market is certainly suggesting that there could be an extension of this performance of IOCs over NOCs. And if you look at forward valuation metrics, and in the case of this chart, on the left-hand side is a forward price to earnings, on the right-hand side is an aggregate value to EBITDA. Really, both measures trying to get at the same thing, which is what does Wall Street think are going to be the premium valuation companies through the course of this year. You can easily reflect, if you look back to year 2000 where these charts begin, you see the yellow line, which are the IOCs, traded at a substantial premium for a period of time. Now that, I think we can all remember the whole era of the super majors, that with all the consolidation, the idea was the technology, the scale, their ability to manage costs, the fact that they were going to be the partner of choice for NOCs, that was going to lead to this sustainable competitive advantage. It was going to create this superior valuation that was going to, of course, last forever. And I think, of course, what we witnessed was that certainly the market bought into that for a period of time, and then by the time we got to 2003, a lot of that had been neutralized. By 2005, 2006, in fact, the NOCs were more highly valued than the IOCs. And then, of course, you see the crossover point yet again, which really coincides with around the collapse of the commodity price, where now the IOCs, in the eyes of the market, are expected to be valued more highly than the NOCs, at least through the course of this year. So let's look at some of the market realities as a background to this IOC issue. And the first kind of familiar old chart, reserve replacement for IOCs. I think we've all seen charts of this nature. This just looking back to the late 90s to 2007. And you see generally in an overall, except for maybe the last few years, a reasonably healthy overall replacement of reserves. But I think, just looking at this only tells part of the story. That a great deal of what was driving this reserve replacement is reflected on the right-hand side, which was just the revisions of the underlying reserves. And a lot of that had to do with the old story about, of course, the old fields and continuing to work the old fields with whether it was technology or better cost or field management that was essentially extending the lives of those fields, creating greater volumes that were economically viable that were giving rise to this reserve replacement. But the point is that this reasonably healthy historical reserve replacement as reflected on this chart was not a function of access to new resources. In fact, access to resources is without a doubt the #1 challenge confronting international oil companies, but rather really through these revisions. And certainly of 2007, a lot of the very positive revisions were driven by, not surprisingly, the peak oil price as it averaged out through the year. And of course, we're starting to see a lot of that reverse now. And so that number will come down substantially as companies continue to report through the course of this quarter. The other, of course, driver is cost, and again, as represented by F&D cost. We all know the story. Costs have increased greatly through the 90s. I think more importantly, when you look at the underlying portfolio of the IOCs, what you see is a tremendous increase in of the non-conventional projects. And by non-conventional, we would throw into that heavy oil, ultra-deep water, tar sands, LNG, GTL. Really projects that are very costly by any measure. And even though, of course, we're all expecting a significant level of cost deflation as we go through these next couple of years, so many of these projects are already in process and have very limited, the companies have very limited abilities to really renegotiate those costs down lower. And you can see, as the chart on the right suggests, when you look at the IOC's portfolios, 2003 to 2010 estimated, you're really moving a significant portion of their production volume into these complex projects. The other implication of these large projects is they require tremendous infrastructure, and that far series of bars which just reflects the percentage of the top 5 projects, which goes a long way to saying that if you're an IOC, as you've been working to replace your reserves, you're entering into these very large, very expensive projects, and it's creating a lot of single project risk on your balance sheet, which says a lot about what you need to do in order to maintain a very strong balance sheet as well as a very sizable balance sheet in order to accommodate these types of projects. As we think forward about the winners, we also are immediately confronted by really 21st century realities as it's being framed in this chart. And here we're just looking at production growth really in 2 periods. A historical period which we've defined as 1975 to 2006. And if you look at that, that's the pie chart on the left. You'll see that the major contribution to production growth during that historical period was really from this category we're calling other. And if you really break back other, the single largest constituent part of other was actually Western Europe and the development of the North Sea during this period. In fact, the IOCs during that entire period had very little access to new reserves. That in fact most of the NOCs really precluded them from making investments in some of the more resource-rich nations. As we think about that and look forward, that's a very important fundamental building block to these IOCs, because while they didn't have access to new areas, they did have sufficient alternative investments that allowed them to build these very large OECD production bases. And it's really those OECD production bases that today are providing the vast majority of their earnings and really paying their dividends. As we look forward, it's inescapable to see that, at least in the minds of the EIA, that the vast majority of the production growth is going to come from OPEC and the FSU, with Latin America representing around 18%. And of course, it's precisely these areas that the IOCs have had the most difficulty in penetrating. The other factor that has weighed heavily into this whole dynamic between IOCs and NOCs has to do with how the market is thinking about emerging market risk. And let me just explain what's on this chart. It's a bit complicated for scale. The yellow line is a basket of emerging market equities relative to a world market index. So as you see that rising to the upper right-hand corner, it's basically showing that from 2004, again, up until the point of the commodity collapse and financial crisis, that you had a steadily increasing equity value among emerging market equities. The green line, on the other hand, is working off a reverse scale on the far right side, which is the spread to treasuries of emerging market bonds. So in essence, as it's also moving in the parallel direction, it's really reflecting the fact that debt was becoming much more cheap to these emerging market companies as their equity values were increasing. I think as we sit, of course, having all in the middle of a financial crisis, I think we can all appreciate or reflect on the fact that that the market has gotten it wrong as it relates to the repricing of risk. And as you can certainly see, as this chart suggests, from that time of the onset of the financial crisis and the commodity collapse, we're really seeing a massive repricing of that risk. But let's talk for a second about what the implications of that are. During the boom period, if you want to call it that, 2004 up to call it July of last year, essentially the value of being a blue chip company was essentially eroded. NOCs had effectively the same access to capital, and the cost of the capital wasn't at all that much higher. So as we transition into a new world, as the financial markets do reprice this risk, and country risk and company risk really come back into the fold, it is going to have very significant negative implications for both valuation on national oil companies, but also their cost of capital and their access to capital. So I think we can all take a step back and say, okay, so we can agree certainly that the oil environment has changed. We can agree that the financial community has changed. I think we can agree that the relationship between producers and consumers has changed. But before we totally declare victory on the behalf of the IOCs, I think it is fair to point out that the IOCs themselves have a number of challenges that they have to deal with. I think you can look at their access to capital and their cost of capital, and while it has been affected through this financial crisis, they still absolutely have access to capital, and the cost of that capital is because treasuries have come down so low, is actually right on par with historical standards. But when you look at the various IOCs, and this chart just puts up a number of example names, Wall Street's basically projecting for 2009 that when you look at operating cash flow and you account for dividends and you account for capital spending, even with the reductions that have been announced, only 4 of these companies are actually producing positive free cash flow. The rest of the companies are actually working on a shortfall. And I might further point out that Wall Street's commodity prices, their consensus commodity prices that are embedded in this type of analysis, rest upon a WTI price of around $55 a barrel. and a Henry Hub gas price, just as two bases for the commodity price of around $6. So I think we can all appreciate that spot prices are lower than that, and strip prices are lower than that. So to the extent to which these companies do in fact realize this positive free cash flow, that's obviously available to be redeployed, whether it's in capital spending or perhaps acquisitions or taking on more projects, or perhaps even used, as it has been historically, for share repurchases. But the point is that things aren't as rosy for this group of companies at, in this case, $55 oil as what some of those former charts might suggest. But before we get too concerned about the financial stability of our international oil companies, we also, of course, have to take into account the fact that they have a lot of cash on their balance sheet. And this just simply looks at those same companies. And the length of the chart, we had to break the bar for ExxonMobil, reflects the amount of cash they just have sitting on their balance sheet, with, of course, ExxonMobil at the top of that list at around $40 billion. But collectively, these companies have around $100 billion of cash that's really sitting on their balance sheet. So I think it's led a lot of people to suggest that maybe they should expect a wave of consolidation. Perhaps they will use these available cash resources to go to places like Latin America and re-enter projects and so forth. But one very important fact I would point out is on this chart, which really is there's a very significant positive feedback loop between liquidity and share price. And let me just explain this chart. On the y-axis here, we actually have the share price performance, and this again since July of last year to present. On the x-axis, we have what we're calling liquidity. Now this liquidity is the most broadest sense. So it includes both the free cash flow you saw on the one chart, includes the cash you saw on the next chart, but it also includes balance sheet capacity. How much these companies have individually that they could perhaps raise debt to create additional capital in order to deploy it. But what you see is, with the exception of the Russians, which we could spend a whole other session talking about, most all the companies, whether IOC or NOC, actually fall pretty cleanly, really, on this line as a predictor. So basically what this means to me as a capital markets person is that the market's basically rewarding people very strongly for liquidity. So it doesn't mean that people aren't going to spend it, but what it does mean is that the bar is very, very high. And what that, again, I think translates to is before they actually commit to spend that capital, they're going to spend it on things that only have the quality and the size and the return characteristics that they believe will truly be accretive to their overall portfolio. So if we go back to the framework where we started and we put the Latin American national oil companies, the Russians, the Chinese, and compare those to the IOCs, on this particular chart, again, we're looking back to 2004 to the peak oil in July of last year, and you can see that the Latin America national oil companies, and this is predominantly Petrobras, had a tremendous outperformance of over 850%, and the Russians were very close behind at around 700%. Chinese not bad at 200, and IOCs, as we saw before, very much a laggard at 91%. But just looking at this small group of Latin American NOCs does mask a lot of regional differences, and I've tried to capture that, at least a flavor of that regional difference in some of these next couple of pages. And this first one is just looking at Latin America exploration drilling, really with the concept that exploration drilling is perhaps one way to think about risk, whether it's country or geological. And this chart essentially shows the number of wildcat wells drilled from 96 to 2008. And you can see the overall level has been pretty constant. However, looking more specifically at the mix, you've seen some definite shifts in terms of the activity level, where certainly over these last couple of years you've seen the preponderance of the activity really being in Brazil, Colombia, Mexico, and Argentina. Now, taking that number of exploration wells, which now is in the form of this purple line, and then underneath that purple line for each of the corresponding years, the size of the bar actually represents the amount of reserves discovered. Again, highlights that it's been fairly erratic, but certainly over the last couple of years, the actual reserves discovered across all of Latin America have been just overwhelmed by Brazil, and particularly the offshore pre-salt. Trinidad and Tobago had a good year last year, but the vast majority of the other discoveries, which you would have seen on the other chart, really represented a number of very small discoveries. And that's important to point out because a number of the countries in Latin America really have moved away from the realm of the IOCs, and I think are really attracting, they're really very fertile grounds for either local companies or smaller independent companies that have the type of cost structure and have the type of skill set to drill a lot of little wells. I mean, specifically, those are countries like Peru, onshore Brazil would be another example, Argentina, and Colombia. Not surprisingly, the countries where you tend to have a high political risk and unattractive physical regime, we really didn't see any discoveries of note over the last couple of years. That, of course, includes countries like Venezuela, Bolivia, and Ecuador. The other way of looking at how capital may flow or what the growth prospects of Latin America is to look at some of the, well, really look at the top projects around the world. And in this particular page, we've taken the world and broken it up into a couple of different pieces and looked at the top 170 projects, of which 21 of those are actually in South America, broadly defined. I mean, these 170 projects represent, on a cumulative basis, around 275 billion barrels of reserve potential, around $1.2 trillion in spending. And I think even in the context of the U.S. fiscal deficit, that's a big number. And even with cost deflation, that will have a positive impact on many of these projects. That's going to be a very large amount of capital to attract, and a lot of these projects that are reflected on this page are actually controlled by national oil companies, not only in Latin America but elsewhere around the world. And I think as we've built the case through the course of these comments, I think it's not a stretch to say that many of these projects are going to face difficulty in raising the amount of capital necessary to see them fulfill their potential. So what's happened since peak oil prices to present? Well, not surprisingly, again, looking at the same framework from July 2008 to present, we've seen an almost complete reversal. Russian national oil companies are down on average about 75%, followed fairly closely by Latin America NOCs at 57, Chinese at 46, and the IOCs, again, as we saw previously, at 35. Now, I think this chart, and maybe I'm stretching it a bit, but I think this chart says some important things. I think it says, from a market perspective, the market, given that we know the resources that exist in Latin America, the market is really questioning whether or not the capital markets and whether or not the countries and the NOCs themselves are going to be in a position to attract the level of capitals necessary to really develop this volume, to commercialize this volume, to really grow their reserves. It certainly suggests that as we go forward that the market is building in assumptions about cost of capital and overall quantities. So let me just conclude with a few perhaps obvious points. One is for, I think, all participants in Latin America, but in particularly the NOCs, that we're going to see a relatively much higher cost of capital. Not only higher cost, but also just a more limited pool of capital, even at that cost, that will be willing to flow to those companies. project and infrastructure financing, which has been a mainstay for many of the large projects, is increasingly difficult, as you would imagine, given the situation involving the world's global financial institutions. But all that said, some of the foreign national oil companies or the resource-short national oil companies or countries may represent a good potential source of capital. And we've certainly seen some of that capital flow to Brazil, and it could certainly flow to some other places, to some other NOCs as well. For the countries that are really reliant on independent and some of the smaller companies, I think what we're going to find is that their free spending days are over. We didn't kind of go through what's happening with independents, but suffice it to say the less well capitalized you are, the more difficult it is to raise capital. And in fact, many of these companies have been completely shut out of the market and only now are really beginning to get very, very limited access. So many of these independents, again, that were relied upon to develop and grow reserves in many of these countries, I think are likely to be in capital preservation mode, if not outright exit. And the IOCs, while, as we've seen, certainly have tremendous potential liquidity, if you are walking a mile in their shoes, I think you realize that they are looking at a lot of different ways to deploy that capital, Latin America being just one. And these companies in Latin America, these countries, the NOCs, the other participants, are really going to have to work very hard to attract their attention and fundamentally demonstrate to them that they'll be able to deliver a risk-adjusted return that competes for that capital in terms of other places where it might flow. That's all I had. Thank you.
Okay, well, I recently presented some of these slides in London, and I made the joke that instead of having to make everybody update the slides, I could just go back to 2004 because the market was kind of about at that level, and that saves the problem for me of having to try to figure out the difference between $100 and $40. So I'm going to talk a little bit just about sort of the efficiency of the NOCs. It was a topic that you didn't bother talking about for 2 or 3 years because the price was so high. But now that the price is low again, it's relevant because if I'm taking a dollar worth of crude oil production and I'm only earning 10 cents on the dollar on it, then that's a much bigger problem in terms of my capital position now than it was 2 years ago. So I'm going to look at that a little bit. Just to sort of set the context about oil prices, and we've sort of touched about it in talking about the outlook for Latin America, but there was a lot of confusion in the market, I think, that's going to start shaking back out probably in the next 6 months. Right now, I think the whole question of what happens with the financial community is so overwhelming that people can't really focus on the fundamentals of the oil business. But there was this mindset, and we had a conference here in May, and I said this in May, it was very unpopular in May, and of course now it's like, seems more obvious, but that there was this mindset that we've had a 200-year boom and bust cycle, but we've moved out of it forever. And we've moved, and you know, people's reasons, you know, to me sounded a little irrational. At the time, I guess they sounded, you know, more rational. But, you know, one was that demand was completely inelastic. And first people said demand was completely inelastic in the United States, and then people like myself stood up with these charts that show that even Americans were driving less, and so people had to move their explanation, so they moved their explanation to China. Right, it was the Chinese were going to just be driving forever, and their demand would be totally inelastic, and everybody's demand would be totally inelastic because all these fuel prices would be subsidized, and no subsidies would be removed. And then the State Planning Commission of China came to visit, and they told us they were definitely going to remove the subsidy that they, you know, was partly having to be the result of their having an inflexible system that didn't move with the market. They were going to fix it over time. And then the last one, which is the one that or two. One was, you know, we've actually run out of resources, and so therefore we're just slowly over time going to work off these small fields we have left. And I was never terribly convinced by that one for two reasons. Number one, you still had large oil companies with top geologists out there selling reserves, so why would you sell reserves if you knew you had the last reserves left under the ground? And the second one, which is I think was even more obvious, is I can take coal out of the ground and liquefy it into a gasoline look-alike. So this idea that somehow there wasn't enough hydrocarbons didn't make any sense to me at all, because at some number which was below $200 a barrel, I could liquefy coal, I could liquefy natural gas, and so it really didn't matter if I had another Gawar, because I had stuff I could turn into gasoline. And the other thing that people just completely forgot about was that we have a global business cycle, and that even if the oil price were to stay high for a period of time, and even if it didn't look like it was going to be an oil shock, you know, and that brings me to my next chart that goes all the way back to the 1860s, right? That there is this coincidence of high oil prices with financial crises, and, you know, it could happen again, which of course we now know that it did. And I won't go into that lecture because that's a totally different lecture, but just to make the point that this has been there is a business cycle, and if you think about the way oil dollars are recycled into the business cycle and create asset bubbles and so forth, you can kind of understand that it was definitely going to pop the way it's popped in the past. So the interesting thing, and I put this chart up and it's not quite updated for '09 yet, but I'll tell you what happened. And people made this observation about this. If you think about like where prices might go and how we were all thinking about them, is to realize, and some of the other, you know, responsible speakers have already made this point, which is it wasn't until, you know, well into '06 that the market was even recognizing the possibility that prior to '06 there was a presumption in the long oil price that we'd always go back to $20. And so we really only had 2 years that the market didn't believe that, right? And that's a pretty interesting observation if you think about how short a period of time that was and how long it felt, right? And then if I were to update this chart, which we're doing another study, so I didn't have a chance to do, if I were to take it out to 2009, this long oil price is no longer, you know, kind of hanging around $75. It's now back to $55. And, you know, Tom mentioned that the investment community is thinking 55. But if we sit at 40 for the rest of the year, you know, my opinion is the market will adjust itself down to the basic reality, because we're a very myopic industry, and the future price is always what price it is right now, and we can't imagine the cycle, even though I just showed it you going back 200 years. So in the end, when $40 becomes the new reality, my opinion is the long oil price, well, $40 will be the new reality, and you see it sort of trickling back down to that. So what does that mean for OPEC and, you know, Latin America specifically? And just to see on a per capita basis, and these numbers come from DOE, the difference per capita per country between this January chart and the 2008 chart, and remember 2008 is already reflecting a half a year at lower prices, is pretty dramatic. And that is what, in my opinion, the Latin American countries really have to face now, is that this, if you think about the per capita income distribution, it's sort of like, how much extra money do I have to spend per person? Is a really interesting way of thinking about it, because of course these are high population countries, and the NOCs have been asked to do all these responsibilities that have to do more with social welfare than business practices. And so therefore, if you look at it per capita, they have going to have a hell of a lot less to work with. And that's going to be an interesting thing for them. So last slide on the sort of general outlook. We have a demand model that we use for other different, you know, many different projects. And usually we use it to, you know, do things like project the demand in Latin America when the crossover will come for Mexico, say, for exports versus imports. But we never use it for the United States, because we're always doing some study on some other country. But we decided it would be interesting to use the model, the demand model for the United States, just so we could make an observation about how long it might take oil demand to recover in the United States, which is a leading indicator for the general market because we use 33% of all world road fuel. And I think this chart is very interesting. We had to revise it twice because we didn't have a negative enough scenario. So if you look at 2009 at the minus 1.5% loss in GDP, which, you know, one could argue might even be a positive, too optimistic a forecast, you can see that that takes, and then having it flatten out to only minus 5% in 2010, you can see that the drop in oil demand continues to go down in a straight line. And it's only if you imagine that we're not going to have a loss in GDP do we get the slope of dropping oil demand come out by, before 2010 or after 2010 or 2011. So I think that fundamentally, and again, to try to move everybody away from the hysteria in both directions, fundamentally, in terms of oil, we're not going to see a turnaround in demand for 2 years, at least. That would be my opinion. So what does that mean for the NOCs? So when we looked at the NOCs, one of the big conclusions of our National Oil Company study was that the NOCs have these national goals and priorities that are non-commercial, that are socially oriented. And I won't go into them at length, but they have to do with the inflexibility of offering fuel subsidies in their countries and having rules that make sure that investors invest in local content and use local contractors and try to create jobs. And my feeling is with the financial crisis, the pressure on those things is going to be worse, not greater. In other words, I'm the National Oil Company, and I can't let up on creating jobs, and I can't let up on fuel subsidies because the politics for my central government to play those roles is greater now than it was when I was making $147 a barrel. But particularly burdensome, I think, on the NOCs moving forward over the next 2 years is that they have this role of not allowing domestic fuel shortages, and that's going to be harder and harder to do, under the circumstances of having not being able to make these investments moving forward because of credit markets or cash flow. Then if you look at the NOCs, and maybe this is partly what the market recognizes in Tom's presentation. So if I'm an NOC and I'm making $147 a barrel, and I'm an investor or I'm the government, I don't really care if I have a leaky barrel and I'm only I'm losing 30% of that in inefficiency. At $147 a barrel, it doesn't matter. At $40 a barrel, it matters a lot. And so what we found was that the NOCs were in the range of 30 to 90%. They had like a growth potential that they could get out by making their operations more efficient. It was a pretty large number. And on average, they were about 35%, only 35% as revenue efficient as a comparable private firm. And I'm going to talk a little bit about that, sort of exaggerating the results a little bit so you can see it in a more simplistic way. But one of the things we found in measuring why the NOCs were so low, and I think it has relevance moving forward between the IOC and NOC relationship, and maybe when we said it when the study came out, it was less interesting than it might be to people now, is that lack of vertical integration was really hurting these companies. And specifically the subsidized products prices. And though, government ownership was another burden, if the state needs to raise capital, the easiest way to raise capital, of course, is to sell a little stake in your national oil company to get the capital from putting those shares on the market or selling those shares to a private party like YPF did with Repsol. So that, I think, might create, if the prices stay at moderate levels, some interesting opportunities. And again, just to sort of give you the background about, will these or won't these companies be under pressure? As everybody keeps saying, only Brazil has an upline in terms of oil production. So no one except Brazil is going to be making up for loss of revenue through price, through volume. I mean, in the 80s and 90s, you know, the lesson of OPEC was, okay, prices are going to be lower, so I'll keep my revenue flat by increasing my volume of production. But a lot of these places are going to have a tremendously difficult time to do that. And this is in countries where, as people have pointed out, you know, a foreign investment is somewhat welcome, or maybe very welcome in the case of, say, Peru or Brazil, and so forth. So looking across the board of companies, the sort of green area can tell you what percentage of the inefficiency of that company, like why they're so low in the line, comes from the fact that their government's interfering in their business and they have too little refining that's profitable, basically. And then to sort of show it to you, and this is a little bit shallower than the analysis we did, so I'm always a little reluctant to show this slide, but I think it really communicates more simply what we're trying to say. And that is and this is from 2004, and that's why I feel like it's a good representative slide, because the average crude oil acquisition price of that year was $36.98, so that's not so far from the current market. So what we're really showing here is that at that kind of an average throughput cost, or an average price that someone was buying crude oil at, that somebody like a BP or a Statoil could make $75 a barrel in revenue from barrel of oil equivalent in that $37 world. But if you take even Petrobras, they're only making $23. And if you take PDVSA, where is PDVSA? Ugh. Okay, they're not on my chart, but they'd be over there, I'm sure, with the NIOC at $12, right? And at a lower price, that pain that you're getting because you have inefficient operations and because you're subsidized, you're basically giving your product away to the population of your country for social reasons, it has two implications. Number one, it's going to take you back to a much deeper slope on these lines, right? And then the second thing is that from our point of view as energy consumers, it's going to mean what are the chances that you're going to have enough capital coming into the industry to provide, the so-called fuel of the future. Again, say you don't believe in my $40 world, say you believe like Wall Street that it's $55 or $60. Again, this just gives you an idea of the kind of revenue that was generated by the NOCs. See Pemex there at half the rate of Chevron. So just an interesting sort of food for thought in thinking about the NOCs and what their path forward would be. This chart just gives you an idea of how unintegrated the NOCs are, say, compared to the majors. And then as Tom already showed this slide, which I took from him, which is just, who has cash now, and, in the end, the IOCs still have cash. And so that, begs the question of, where should the NOCs be going moving in the future, especially if this strategy they've had over the past 6 years, which is they're just going to, tap the international capital markets, is going to become harder to do. And so, given the benefit that would come to the operations of these NOCs over time of vertically integrating, and given the fact that the major is probably not too happy owning a lot of downstream capacity, because it's less valuable to them, maybe, than it would be to an NOC. There does seem to be some sort of natural synergy that comes not from the traditional place where the IOCs are saying we get, better technology and we'll come here and use it in your country, but from a sort of alliances that are upstream and downstream. So, and then I just, my 2 minutes, since I feel like, we have to close the conference by just saying that we're going to have a different path forward. And so when thinking about how long it'll take demand to rebound, and thinking about the fact that the US is sort of a leading market for oil use, I like to show this slide, so I leave my audience very pessimistic, which is how much oil the U.S. could save if we actually went to Obama's plan to have all cars in America have a CAFE, corporate average efficiency standard of 50 instead of the 35 that's now on the books. And you're talking about almost 7 million barrels a day. And I like to remind people that that's the exact 7 million barrels a day that people are touting around for the increase from China. So Obama, with just one policy, not 100 bills, nothing, just one policy, now that he's got Detroit on their knees begging for money, right? Just one policy to have Detroit produce a car that gets the same gas mileage as a Prius, which the Prius gets it, so it's not like it could be physically impossible to achieve in 10 years, right? Would eliminate the entire boost the market gets from demand from China. So anyway, that's my talk, so let's, I guess, come back up.
Wow, lots of food for thought there. Both of these. All right, so we'll have a few minutes for questions. Any questions? Stunned.
I was struck by Amy's slide regarding the lack of integration by the NOCs and how it relates to Mr. Langford's talk in particular, because I think if you took your first slide that showed the IOC and the NOCs and their relative valuations, and you replace those with fully integrated companies and pure upstream plays, you would see a similar picture, I think. So I guess my question would be, are we reading too much into your analysis as it relates to maybe geopolitical risk or other factors in terms of capitalization?
You want to take that first? Go ahead. Well, I think clearly the market gave the NOCs a premium because they said they've got the reserves and, the IOCs are losing access and, all they've got is money and the NOCs don't need them. There was this perception that the majors had become a bank and the NOCs could go to Tom and just, do an IPO if they need a little cash to invest somewhere. I think the myth of that, and we've looked at that because there's a group that's doing a book on governance. I think the interesting thing about that, thinking of Wall Street, which I think is kind of the thinking, is that actually all the IPOs, especially the Chinese, but even the other ones that we've seen, the countries didn't do an IPO to get extra money to spend on exploration or refining. They spent it they did it in Latin America to reduce debt, general government debt. And they did it in China, same thing, to change the position of social things they want to do, whether it's to retire their pensioners or to do other things. And the money, that wasn't what allowed CNPC or CNOC to go, invest in Sudan or Venezuela. So I think the first thing to really self-correct is this idea that somehow the NOCs went to international capital markets to explore more, and therefore their reserves are more valuable because now they can come out and do these IPOs or partially privatize, and therefore they're going to tap all those reserves. My opinion is the market was just wrong, right, about how they perceived that, because there was just huge risk, which we're all now talking about today, about whether they'd actually invest the money. Right? To me, that was the conclusion of the National Oil Company study, was you have all these things that inhibit these companies from actually investing. And so you have the cases like Statoil or Petrobras. But I would tell you that, in my opinion, it's just an opinion, maybe it's because I'm from America, part of the thing that made Statoil and Petrobras was they had competitors in their own sector. And they had to keep up with those competitors. Right? And so, in a place like Saudi Aramco is a great, well-run company, but they're not going to get the benefit of that because they're not facing that kind of competition. right? So maybe in their case, they're not capital short, but in places where now, like Russia, where people are going to be capital short, it's going to be a bigger problem. The second thing I would say is that, you know, just because I own this oil under the ground, if I can earn 15 times more with it, if I turn it into petrochemicals and all these other things, even though it might be that there's some Wall Street analyst out there that can say that petchems are going to look bad this year, or refining is going to look bad this year, the bottom line is the numbers don't lie. And the numbers are that, you know, BP was earning $75 a barrel in a $36 world, right? And ultimately, as I move forward, and you can see what happened with Statoil, because they privatized and then they got to the same place. Ultimately, you know, I'm trying to get government revenue. And if people would look at government revenue differently, which is I'm just trying to maximize my revenue, and then if I have to do something for people who are poor in my country, you know, maybe I should build schools so they have a better education, or provide them with public housing or something like that, instead of giving them fuel for free, which is the one thing I have to earn money with. You know, maybe that would be a better approach, right, than some of the strategies that are currently used.
I would like to ask a question that both of you are making the statement, or at least you are making the statement that NOCs are going to play a critical role in the future. And Amy, you showed that NOCs are not as technically efficient or financially efficient. What does this mean with respect to the future? You also said prices will go up and down. If these NOCs are not able to plan and produce or increase the capacity like IOCs have done in the past, what will happen in the future?
Well, I mean, that's why I showed you the first chart, right? So even though I'm showing you all the reasons why we're going to, you know, demand is going to be low for 2 years and so on and so forth, you know, that doesn't mean we're out of the woods and oil prices are going to be low forever. There's no forever in oil, right? And then that's, we're going to be back in exactly the same position we were last year or 2 years ago if there's not adjustments made. And that's why it's a really critical issue, you know, that Tom was showing the statistics, and of course, you know, we're here to talk about Latin America, but, you know, how much capital the IOCs have, and even the independents and how they deploy it, is a really critical issue, because in the end, the reason the natural gas price in the United States is so low is because, in my opinion, you know, companies didn't think there was that, you know, we've all heard analysts from Houston say that we've totally have no more natural gas in the United States. I mean, I've had people come here and say that in this very room, and we now know from the drilling by little independent companies in the United States that we have more shale. We have, I don't know, 400 TCF or 350 TCF of shale that, you know, 5 years ago or 10 years ago, no one was making an assessment that large, and now people are saying that, you know, you get the same shale structures in Eastern Europe and, you know, other places. So, you know, my experience has been over the 30 years I've been in the oil industry that technology changes a lot of things. And this nonsense that people say that, you know, we have to have $80 because, you know, that's what it costs to produce the marginal barrel, right? You know, I was just joking with somebody from Shell last night. I mean, you know, Shell was doing tar sands for $10 a barrel in the late 90s and even maybe in 2002, 2003. So depending on what happens with the global economy and iron ore production and, you know, drilling companies laying people off and people having to take a job at a slightly lower salary, and you see it already in Canada. I was up in Canada giving a speech, and, you know, people there are really worried, and the government is going to have to take off the taxes to lower the cost of doing tar sands. So you're going to have these two competing trends. You know, there's a lot of drilling happened over the last 6 years, and it identified a lot of new kinds of assets, and the majors will be able to come into those assets and lower costs because they have to, and with the history of their doing that is very strong. But on the flip side, you know, you have a lot of places where you're almost putting up a sign where you're just, you know, you just, like Mexico, where you just put in a sign that just says, just ignore this map. Like if you were making a model of where oil production was going to come in the future, you're just putting a computer block on any resources in this country or that country for this reason having to do with the NOC inability to either now raise capital or B, productively, efficiently operate with the capital they have.
Well, I would just add, too, that I think it is dangerous to generalize like many of these slides did, where you're throwing all the NOCs in a big pile and doing averages and aggregates versus the specifics. And given this is a Latin America conference, I mean, it's very illustrative to look at Petrobras. Petrobras, at the onset of the financial crisis, Brazil was effectively locked out of the capital markets. They could not raise debt. Petrobras, we all know, has the great discoveries. It certainly captivated this twinkle in every energy investor's mind about how can I get money into that play. The issue was simply that these things just take a while. I think we're in a period right now where Petrobras is along with some of its IOC partners and service companies really working to delineate a business plan that people can understand if it's investable and what the returns are going to be. And if we were successful in raising some significant capital for Petrobras about a week or two ago, and it is interesting to follow that progression in that Petrobras did have a lot of trouble in accessing the markets directly. Ultimately, they ended up going to financial institutions because it took the level of technical assessment that a financial institution can undertake to really understand the business plan and the profitability and how the money is flowing, such that they got to a level of comfort that they were willing to lend those funds, which then could be taken out by the capital markets, because in effect you were essentially paying the banks back that had already those banks imprimatur that this was going to be a good investment. So some of this is just a progression, and clearly capital will start to flow back. I mean, the fundamental issue with the IOCs still remains, which is it's all about access to resources. If you break the IOCs into all the constituent companies and follow their histories over the years, you'll find that those that are able to successfully grow their reserves and provide or demonstrate to the market an ability to create value consistently are in fact rewarded, and they're rewarded commensurate with or even greater than some of those charts for some of those graphs or elevated graphs that the NOCs would suggest. So I think what the market is simply saying that when you see an NOC, you see an NOC like a Petrobras or others that do have these tremendous reserve base, whether it's through service companies or whether it's through alliances or whether it's through their own skill set or incrementally building it, that they'll work through that, and that's going to be, to the extent to which people can understand the fundamental character of the reserves and the cost to deliver them, going to be a very attractive value proposition. So I have to be, I'm just somewhat cautioning that it's easy to make some kind of sweeping points off of some of those charts that were presented, but of course every story has its own specifics.
We're at 4:15. I don't know if you want to end it or...
What would take one last question and then we'll
Okay.
close up.
All right, so one more question.
Well, I just have a follow-up question on the idea of NOC's access to capital and the cost of getting that capital. And kind of going back to what we talked about this morning, do you see those issues kind of helping put pressure in some of these countries on getting some of these reforms passed through, because they're not only getting pressure from taking in less revenue from the oil price coming down, but if they're having to also pay more to get investment funds, I mean, can that maybe help change some of the dynamics that we've been talking about?
Well, I'd be interested in Amy's comments on this. I think as an investment banker and trafficking somewhat in the short term as opposed to the very long term, I think this is a tricky time for the international companies, because yes, I do think that certainly there are a number of situations where host governments are considering changes to projects, changes to physical regimes in order to attract that IOC capital. And the question becomes simply, if you're in the shoes of an IOC, you've seen this play before, where you're effectively utilized as a bank when times are tough, but under the assumption that we are working on business cycles, and while we might never quite get back to the heady days we had prior to the collapse, capital will become more available, more plentiful, cheaper, And therefore, when you reach that crossover point, will in fact all of this revert back and those seem NOCs. I'm always struck by the fact that when you go back to, if you just look at BP and you look at BP through the 70s, you can find a point in time where BP was producing about 4 million barrels a day. And then there was a whole wave of nationalizations, and I think at their low point it was something like 700,000 barrels a day. And then over which was a great boon to Wall Street. Any number of acquisitions and deals they did, whether it was Amoco, Arco, TNK, et cetera, surprise, surprise, they're about back to 4 million barrels a day. And so if you're sitting and you've lived through that history, I think one has to be very wary and really think through quite carefully the lessons learned of the past, whether it's sanctity of contracts or political stability or structures or operating agreements or other types of acquisitions or alliances that might allow you to at least appear to be achieving your competitive success. But I wouldn't underestimate the amount of pressure on all these IOCs because in a sense this is the period that they've been waiting for all that period where you saw their line and the NOCs appreciating at a much rapid rate. This is the period where this cash, their position, their skills, where perhaps the old, going back again to the era or the heralding of the era of the supermajors, where scale, financial firepower, technology was going to create the partner of choice. Maybe this era, maybe this does represent an entry point, but again, we've learned a lot of lessons, and that's what's going to make these next few years interesting.
I kind of defer to David. I don't know in terms of how it's going to affect the internal politics. Do you have any thoughts on that?
Well, I mean, again, it's going to vary by, not only the country's particular situation, but what the structural politics is there. I mean, I think one of the things that has helped Brazil is that it is a competitive political system. We've been talking about competition in the oil industry. Well, competition in the politics in Brazil has made it very difficult for anybody to move to the extremes. Even in the case of Mexico, I mean, the fact that it was competitive, I think, is one of the things that helps us understand even the PRD's inability to build on its perhaps stolen election. If you go to Bolivia or Venezuela, what you see is a move to build a huge political movement that dominates the system. And when that political movement dominates the system, that political movement can essentially implement huge changes in policy, for good or bad. Okay, but it makes those huge changes. When the energy prices were real high, it looked to everybody like, wow, politicians believe just like the markets believe that, this is where the oil prices were going for the future. So now we could solve all of our issues, and they were able to do that. Bolivia, I think, has suffered dramatically because of that. They now have a new political structure in place, but they're losing markets. They don't have the capital to even deliver on the oil that natural gas that they believe they had 5 years ago. They've been constantly re-estimating their reserves downward. They can't even hire a firm to come in and certify their reserves. I mean, it's a total mess, even though it should have been a time of incredible bonanza for Bolivia and the opportunity to structure relationships with Chile that would guarantee long-run future benefits. But I think there the politics are what got in the way, because you could actually dominate the whole system.
So I would just add one other sort of thought for thinking. I think I'm already seeing a little bit. It's too early to say it's a trend, but I've asked a couple people, and you can, at the coffee break, you can go ask the people who are here from those companies. But I've asked some people who are in exploration or corporate planning for the majors, if these countries, because people, it came up, media was asking about Venezuela having a new tender round. And I asked people, and Tom showed the slides, you guys are doing these expensive projects and unconventional resources. If somebody comes in at this, $4 resource and they want to let you in, are people going to shift their spending away from unconventional? And so far, I have yet to find a company that said, no, we're planning to shift our money away from unconventional. People are going to stick with unconventional, and the plan is prices are low, we got to cut costs. So you're seeing a few people lose their jobs, or you're seeing, them cut costs in other ways. But I think the reality is that these unconventionals are going to be protected by the governments for where they live. So the Canadian government's going to do what it has to do to protect the unconventionals. In Canada, you're going to get the people who have shale. Even here in the United States, where oil companies are so unpopular, when the public starts to get a little bit more educated, maybe we're going to find that we don't want to have our production. We don't lose the production gains we've already had, so you might see something come in here. UK and Norway are already talking about what kind of incentives, with the whole Russian scare, they're talking about what kind of incentives, they tax relief. And even with the pressure on financials for the Western countries, the OECD countries, I think you're going to see the competitive fiscal terms come there first, right? And so I think that that's going to mean that if you're a country that's flipped people around over the past 6 years where you've changed what you're doing, the companies are going to go to you last. I mean, unless you're Iraq, where it's just, the resource is just so huge that, you can't turn your head. But really, truly, the companies made these portfolios in the OECD for certain reasons, and I think they're going to be reluctant to just completely move out of that. And I think those governments are going to be responsive to doing something to keep them from moving out of that. Because it's going to make a policy, national security, energy security, blah, blah, blah. So I think you're going to find that, even though I agree that the majors have been waiting for this day for 4 years, where prices will be low and the NOCs will come back crawling and blah, 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 I just think that it's going to be a much slower process than people imagined. And that I think the NOCs are going to be sticky on the way down. And I think the majors are going to be cautious to go back in.
Okay, well, let's call that a wrap on that note. And now we'll turn to Amy's wrap-up. Are you going to do a wrap-up?
You want to do the wrap?
I didn't prepare for a wrap.
Okay, I'll do the wrap. Okay, let me go back to the podium. So I want to thank everybody for their presentations today. It's a very interesting day. I think I have a few takeaways. It's always, like the rest of you talking about being on the cuff here. So same thing. I have a few takeaways. I think that one of the biggest takeaway is that we're in a period of transition. And it's unclear how these changes that are going to have to take place are going to play out, and maybe it'll vary country to country in Latin America given the politics. But it'll be really interesting, I think, to me as an observer who doesn't really study the region, carefully, to see the interplay between the kinds of transitions that are going to have to be made and how it affects the popularity of populism and some of these sort of government or ideological trends that have been seem to have been gaining momentum in the last 5 years. The second thing I think that's interesting in thinking about the trends that were discussed over the day, I think with the points made in the different panels about the rejection of these ideological schools and a move to a much more pragmatic, individual basis, case-by-case analysis of what I should do in the industry. So, maybe communism was discredited, and now maybe, and then people felt very negatively about the Washington Consensus, and now even, liberalism seems to be it's not just the Washington Consensus, it's not just I have to watch my inflation rate, but just the whole idea of what privatization gets me and you know, whether I want to follow Wall Street's cue on how I reorganize my financial sector or how I reorganize my energy sector. So it's almost like there's a no leadership, we're in a no leadership world, and it's not clear what the paradigm that's going to come out from this is going to be. I found Tom's comments kind of interesting because it like reflects everything from how I view my personal finances to probably the way the IOCs look at it and the way governments are going to look at it, which is that I endanger myself if I take on too much debt. So I see these opportunity from deflation, and I have this personal story I tell people. It's kind of, you know, personal story that I think really sums up like the global economy, but certainly the American economy, which is last year, I'm visiting my mother. She lives in Boston. It's very cold out. And we go shopping together. And I see this beautiful, you know, suede shearling winter coat, $1,500. And I say, you know what, I live in Houston, you all can see what the weather's like today. And should it really worth spending that kind of money on a coat when, you know, it's never cold in Houston, I'm only gonna wear it when I go to a conference in New York or London. And, you know, you go out of fashion too fast, it's not worth spending that kind of money for a winter coat if you're living here. So this year, about a month ago, I'm taking the kids to the mall to get sneakers, and I'm walking through Burlington Coat Factory, and I see the same exact coat. And it's on sale for $99. And I try it on, and it looks just as good as it did last year when it was $15, and I don't buy it. And the lesson of why I don't buy it is I'm saying to myself, you know, God only knows what's going to happen with my bank and the dollar and all my asset holdings, and I shouldn't be buying something, even if it's $99. I shouldn't be buying something that I don't need just because it's $99. Right? And so, you know, if you like, you know, multiply that by everybody in the world, I mean, the point is, you know, people are going to look at these projects. I think Tom really summed it up. People are going to be looking at these projects really critically, right? There's going to be a concern about taking on debt. And so it's all well and good to say that I'm very concerned about climate or I'm very concerned about this or that. But, you know, we're going back to a bottom line world where my ideology about what I'm going to do is going to be less important in my view than whether it's going to pay for itself or not. And it'll be interesting to see, because I think that world could bring a big change in sort of business paradigms for Latin America, because it's been a place where, you know, we're all leaping to privatization, you know, like over a cliff without thinking about what it means, and vice versa with some of the movement back to, you know, populist social welfare programs. So I see like maybe the path forward. Be interesting to see if it turns out, as some of the commentary today, to be a sort of a more practical, pragmatic, less ideological future. So with that, I thank you all for coming. We all run around and try to get everybody to sign a piece of paper saying we can post their slides on our website. So I would expect sometime in the next couple of days. These have been very interesting presentations with a lot of really interesting data. They should be up on our website, which is www.rice.edu/energy. I want to thank again the Council of Americas for partnering with us and doing a lot of the heavy lifting, and also my partner in crime, Erica de la Garza, in the Latin American Initiative, for helping bring some muscle to the Latin American aspect of our looking at energy, and to my staff who managed to throw this conference together while we were finishing a major study to be released in Russia in 3 weeks. So we were both proofreading and doing agendas all at the same time. So if you see a typo anywhere, that's why. But I really want to thank you all for coming today, and we look forward to having more series on Latin America. We have looking forward, Eric and I are talking about trying to, you know, we had to be very general this time, so we're going to try to do country by country programs where we have a half day on Mexico or a half day on Brazil, and try to sort of move forward on that basis. So keep your eye out for new programs coming forward. Thank you very much.